Okay, in this second video, we're going to start with taking a look at uncovered interest parity. And uncovered interest parity is an approximate relationship between the interest rate differential and the expected appreciation or depreciation in the respective currencies. So if we've got two currencies, two different countries with a difference in the interest rates in those countries, we're going to have some changes in the respective values of the currencies. One is going to be appreciating compared to the other one if there is a differential in the interest rates. So this next bullet point is an important one. The currency with the higher interest rate is expected to depreciate by about the difference in the interest rates. Now this is maybe a little bit counterintuitive. Maybe you would think that the higher interest rate would mean it's going to have appreciation, but we've already looked at interest rate parity and the covered interest arbitrage notion, and it works out. You can show yourself that it works out here that the currency with the higher interest rate is expected to depreciate by about the difference in the interest rates. So for example, if the US interest rate is 8% and the British interest rate is 3%, then the expected change would be about a 5% depreciation in the dollar compared to the pound over the next year. So we've got a 5% differential, and the uncovered interest parity notion says this gives us an approximate relationship or an approximate expectation of what's going to happen over the next year. Now it doesn't mean that this is definitely going to happen. There could be other things that happen over the course of the next year that change this, but with looking at the 1-year interest rate at a particular point in time, it gives you a notion or an idea. It kind of drives your expectation about what's going to happen to the currencies relative to each other over time. So that is uncovered interest parity. Okay, let's move on and take a look at the currency carry trade. So this is a currency trading strategy where you borrow in a currency with low interest rates, and historically Japan has been a very common or a very popular destination for borrowing because the interest rates there have been quite low. And you'd borrow and invest then that money in a currency with a higher interest rate. You'd convert it, I should say, first, and then invest it in a currency with a higher interest rate. So destinations such as New Zealand or Australia have been popular in the past. I've put a post to an article about Iceland. That was a popular destination to invest currency. It had high interest rates a number of years ago, and it spectacularly blew up. So a good article to look at to get a sense of the currency carry trade and the risks involved with this carry trade. It's not a riskless venture for currency traders. But the way traders make money here is as long as the interest rate spread is greater than the rate of appreciation of the currency, of the borrowed currency, then the trade will make money. So for instance, if the New Zealand interest rate is much higher than the Japanese interest rate, and as long as the Japanese yen doesn't appreciate by that amount, then we will make money. This might be best seen in an example here, so let's look at one. We're going to use euros and rubles here. So for instance, let's say we're going to borrow 1 million euros at 0.35%. So Europe also has very low interest rates. We're going to convert that to a currency with a high interest rate, and rubles fits the bill there. We're going to assume a 10.12% interest rate in Russia. So we're going to borrow 1 million euros and convert that to rubles. Let's assume that the exchange rate is 83.53 rubles per euro. We would have then 83 million, a little over 83.5 million rubles to invest. We're going to invest that at 10.12%, and after 1 year we would have a little under 92 million rubles. So 91,983,000, etc. On the other side, over here on the left, we've borrowed 1 million euros. The interest rate we're borrowing at is 0.35%, so after 1 year we would owe just a shade over 1,003,000 euros. So now we've got an interest rate differential, right? The difference between the 10.12 and the 0.35%, just under 9.8% is the difference. So here's where the currency carry trade can make money. If the euro only appreciates by, say, 8%, that's less than what is kind of suggested by the uncovered interest parity, then we will make money. So let's just see how that would work. We're going to convert the rubles back to euros at the new rate of 90.212. That's 8% more than the 83.53 rubles per euro up here. And we will then have 1,019,000 euros if we convert the 91 million rubles back to euros at that new exchange rate, that only appreciated by 8% exchange rate. And so what happens is we've made money, we've made 16,000 euros on this transaction. So as long as the appreciation rate isn't quite what it ought to be, then we make money. And this has been relatively popular trade, again, using Japan and countries like Australia or New Zealand in the past, but it's not foolproof, it's not arbitrage, it's not an arbitrage opportunity. It's just taking advantage of exchange rate changes that don't quite match the interest rate differential. So let's move on to the next notion here, and that is the idea of purchasing power parity. So purchasing power parity suggests that the exchange rates between countries should be equal to the ratio of the country's price levels. So for instance, if we had a basket of goods that if we bought it in Germany, if we're paying euros for it, we had to pay 100 euros. That same basket, if we looked at it in America and the price was $125, purchasing power parity suggests that the exchange rate should be the ratio between those two price levels. So $125 would be equal to 100 euros, and the exchange rate would be $1.25 per euro. So that's what purchasing power parity is suggesting. We have these basket of goods in two different places, and we equate the exchange rates by the value or the price that it costs in each of those respective countries. Now, this is not what you typically observe. Absolute purchasing power parity does not really hold. If you test it empirically across time, it's not really a good measure. But relative purchasing power parity can be a bit more helpful. This notion suggests that the relative changes in prices between two countries, that is to say the relative inflation rates between these two countries, is a good indicator of the future change in exchange rates.